Hi, good morning. I think we're good to go. Uh, as we begin this map session, this is like the ninth edition of the map session. We started in July last year. I think we have covered so much ground over those 9 months that uh, I think practically we've discussed so many things. And over the last 3 or 4 map sessions, what I've realized is that I think we've never entered a session in which I think which is one without drama as such, for a lack of better word. Yeah, I mean, we entered January on the back of a silver and gold run. I think we entered February on the back of um, India signing the trade deal, or about to sign the trade deal with US. I think this month we start with Brent going above $90 overnight. So I think something that is what we prepared for. We've been talking about this since the first webinar session that we had. That the world continues to be a very volatile, ambiguous, uncertain, and complex place. And we've been talking about this on LinkedIn. I've been talking about this on LinkedIn, on other social media forums since the last 2 to 3 years. That we have moved to a very different world. This is not a world where you can just buy, shut, and forget. It is more that requires more nuances in terms of how you position yourself, not based on what happened yesterday, but what looks like happening a few months down the line. It's more of a game of probability at this point of time, rather than you could just buy something and keep hold of it. This market is very different than what one saw between 2021 and 2024, and that is where we believe that a lot of people struggle through, because you buy something, and that comes through panic, and then sell, and then again buy on the higher ground, which is where the market has remained choppy over the last 1.5 years. And despite that, we continue to produce positive returns, because we've been able to read the cycles well. So let me just share my screen and let's begin today. Um, just a quick thing. Is my screen visible?
Yes, yes.
Sure. Thank you. So today we're beginning this market action pulse, the March edition. We're claiming that this year could be the year of black gold, which is basically oil. And of oil of late has started leading for reasons whatever they may be. Uh, and what we've realized, that when oil leads, inflation generally follows. It didn't ask permission in the 1970s, and it's not asking now. This is then nuance to what, if people have attended our previous session as well, and I've been very vocal about this. This particular period in the market looks very similar to the one between 1970 to 1980. We, especially as we move forward, we'll realize, and even in the last map session, we discussed at length that why this particular stage looks like 1979 all over again. Just before we broadly start, a very big disclaimer here: we're not war strategists. We honestly don't know what the outcome of the war would be, who should lead Iran, who not. That's not the place that we specialize in. We specialize in understanding market cycles. We specialize in how to place yourself, how to place the portfolios in terms of risk, in terms of how the markets are moving, and anything that we discussed today here is basically not a recommendation. It's our read on the market. Any names that we discuss, any particular stocks, again, there's no buy, sell, hold recommendation as per. If there is a buy recommendation, and if your client is already there in your portfolio, we continue to monitor portfolios every day. So if it's there, it's there. If it's not, there would be reason for it not to be there. Any, again, performance that we discuss is prior performance. Prior performance is not an indication of future returns. Market cycles are different, and we respect the cycle, we respect the structure, and we position ourselves accordingly. Uh, we, we, we again have, similar to last time around, we have 3 chapters this time around. The first chapter reads as reading the room. The chapter 2 is oil doesn't ask permissions, and then the chapter 3 ties all of that together into our positioning into the market. Uh, as we always do, let's just quickly look at the report card from last month. India lagged US and China, at least the headline index lagged both US and China, while the broader markets have started to pick up a bit, at least in terms of mid cap and others, they've started to pick up a bit. We still continue to lag. However, this short term underperformance is kind of a feature. This is the cycle dispersion. This is not a problem. This is basically an opportunity, and this is the opportunity that we are playing out. So last month we said that India's short-term pain was basically positioned inside a demand zone. We continue, we are there, and effectively China 25% over the last 1 year. We went long China last year again beginning, and that has provided us much more relief in terms of performance, whatever wherever India has kind of lagged behind. Again, cycles are, this is a market that is choppy, no, there's no doubt about it, and cycles are turning very fast. From a last month map session, this is how we positioned ourselves. Just we were not aware that whether there would be a war or there wouldn't be a war, but at that point of time, energy and infra looked really good to us. Valuations were of comfort level. There was a mispricing in the market where energy was continuously being discounted for. We didn't understand the reason for it, and we positioned ourselves overweight on that. And then whatever followed happened because it had to, and those positions have started giving us returns in a way. How we are positioned in terms of fundamental, US is a place that honestly is very difficult right now. The GDP is down from 4.4% last quarter to 1.4%. It's a big drop in GDP in 1 quarter. PMI levels are at 51.9, the composite PMI, while the non-manufacturing PMI is increasing, the manufacturing PMI had dipped quite a bit. So overall, the composite PMI continues to be at a 10-month low. Tariffs are raising cost. The inflation is continuously being sticky around 2.5 to 3%. We also realized that the government went through a shutdown period last year as well. Somebody who came out with a very weird inflation report was sacked. So how good is the data is for one to really kind of debate on. But whatever the data is, whatever the headline number is, it does not look honestly to be very good at this stage. And that is why you see US moving into a cycle which is very much similar to India from October last year, just before the shutdown, to now. I think US markets have become superbly choppy, similar to how we've been doing since the last 1.5 years. UK is in turn turning a corner. The PMI has hit a 22-month high in February. It is the fastest expansion in the last 2 years. Exports are surging there. Growth is barely coming in positive, but this is something to look out for. Again, at this stage, UK markets look decently well. There is rate cut likely in March, and we've been watching. We've still not positioned ourselves in UK yet, but we've raised our watch over there. In terms of China, manufacturing momentum is building. PMI is hitting a much higher level. Export machines are intact despite all the tariff news. Now, even though the Supreme Court has knocked off the tariffs, there is other ammunition that Trump has where he can go ahead and disrupt the whole trade regime. So we are looking at it, but it continuously looks better. GDP growth obviously would have taken a hit because and they have over the think tank in China has reduced their outlook for the GDP growth over this year. This is one of the slowest growth that they have forecasted. But China is known to surprise at different levels as well. They have the machinery to bring out stimuluses as well. Japan is another one that is turning around a corner. We've discussed Japan at length, I think somewhere around August. When we discussed it last time around, there was political uncertainty. That political uncertainty is out of the picture now. There is a resounding victory for the person in charge now. And the reform story is continuously improving. Eurozone as well has shown one of the strongest reads since mid-2023. So, where we worked our watch is basically UK and Eurozone, the two places that we continuously were underweight. India continues continuously does well. It is continuing to do well. PMI reads above 58.9. We've seen this around 60. It's way in the expansionary zone. It is still the highest PMI in the any major economy. PMI is basically something which is a leading indicator. You have this. This is something that purchase managers fill out a survey and give you a read of how they think they would be purchasing in the future. So that's a very strong number of nearly 59. We've seen this across time at being at 60 as well. GDP again continues to be strong. However, the GDP read is from the last quarter. This quarter, we expect the GDP number to be slightly lower than 7.8, slightly above slightly above 7%, 7.0%, but less than 7.8%. Inflation has ticked up. However, we've got an entire slide on this, that this has ticked up because we've changed the basket as well. The new basket makes the whole scenario very, very interesting, and we'll take a deeper dive into that. Just coming into this is again from the last map. If you've not seen this before, what we've done is basically we've overlaid the 1970 to 1980 bull run in precious metals. So what we've done is basically taken. So if you are in investments, or if you're looking at markets and probably looking at gold and silver at this point of time, we only know of one big bull run, which is between 1970 to 1980. The other bull run that is happening right now starts from 2000 to the beginning of this century, and it's continuing now. So what we've done is we've overlaid that 10-month period with the 10-year period with this 30-year period. So 10 years between 1970 to 1980, and 30 years from 2000 to maybe 2030. When we overlay these two charts, very surprisingly, they overlap like almost nearly to the tick. And when we looked at that, we still believe that silver and gold both have more room to run going forward. Now, the problem with this is that people have become very short term in gold and silver. Gold and silver have very long cycles as such. So again, this is a very common theme that you should not be looking at gold and silver from a 1 month perspective or a 2 month perspective. If you bought at the beginning of the year, probably, or let's say at the end of somewhere around 20th of January or 25th of January, probably you'll be sitting on losses. But this is a feature of it that you cannot look at gold and silver from a shorter time period. However, we continuously get the question around what should we do with our gold and silver. First and foremost, do not look at it from a monthly perspective. Look at it from more of a inflation perspective, because gold and silver have stopped becoming hedges. Now they've become an entire inflation story, and this is like the first chapter that one has to read into. We'll deep dive into this inflation story going forward, but again, continuously that we get this short term question again and again as to what I should do for gold and silver. Then what we did was that we kind of zoomed into this previous chart. So basically, this chart starts from 1970, ends in 1980, starts in 2000, ends in 2030 somewhere. What we did was we zoomed into this period, because this is where we are right now. And both for silver and gold, we've zoomed in and looking into it. So the dispersion that you see right now, or the breather that they are kind of catching before a sprint up, this was similar in 1979 as well, and it's probably following a similar path at this stage. Both of them are following a similar path as such. If we overlay 1970 with this particular bull run, then chances rise that maybe silver and gold can continue their up moves beginning, let's say, ending June or beginning July. Again, caveat here, this is a cycle that is, when we laid it on top of each other, it started matching. There is no reason for these two cycles to match each other, but it is following the script. So if the script follows forward, then June and July is when we expect precious metals to pick back up again. And for the next 2-3 months, you can expect them to continuously remain sideways, as it is shown in 1979. Now, this is a very interesting chart. What we realized was that there is something called M2. M2 is basically the money supply in the market. When you look at the money supply, basically your equity market should ideally never be greater than the money supply, right? Because or the growth of money supply. If you're growing faster than the growth of money supply, that creates a problem. That creates a leverage position. You are basically borrowing money to kind of put into the market. When we actually looked at it, there are two stories here. So one on the left hand side, you can see the United States story, and on the right hand side, you can see the India story. When we looked at United States, the market is outrunning the money, the printing of the money or money supply. So starting here, whenever this has happened, this last happened in the late 1990s, which was followed by a dot-com crash, and when eventually you kind of came down below the money supply. Similarly, it tried to move ahead during the 2008 crisis, and then you were picked back. Similarly, you tried to move ahead of that regime, and you were pulled back by COVID. But this was a major chunk. This is the time that it spent a lot of time above the money supply. This is a very similar phase as to it is spending a lot of time above the money supply, and that ideally means that the market is in a bubble territory. And when we've said it openly out loud that AI looks to be in a bubble, given the atrocious valuations that we've actually given to the market. Does this bubble burst right now, tomorrow, 3 months later, 3 years later? We have no idea. Honestly, it's very difficult to time when the bubble will burst. So the way to do this is position yourself lightly, at least in these markets, which are running ahead of their money supply. On the right-hand side, a very similar or very different story, rather, the opposite of that end. Money supply in India is kind of at a higher level than where the markets are at this stage. Only one time in our history we've gone ahead of or taken very high leverage position. That was in 2008, and that was followed by the great financial crisis. We are way down here in terms of leverage positions as such. So there is a lot of room to catch up, at least in terms of money supply. So that is why the positioning for us has always been higher in India rather than in US. And that makes more sense to us in a way. The US has probably crossed a line. We obviously don't know when it will correct. But what we know right now is that India hasn't crossed a line, and that is where we are exposing ourselves to. As I said, we'll talk about the CPI basket. The CPI basket has materially changed. The new print basically came out. The new CPI basket. The new CPI basket now takes away older names like, the older basket had VCR, etc., stuff that we don't end up using. We now use Netflix. So that is what has kind of come into the new CPI basket. The major thing here is basically that food and beverages, which had an older weight of around 46%, has kind of reduced to 36.8%, nearly 37%. Housing has increased, transport has increased, and health has increased. This new basket looks much more similar to how richer, more urban India is looking at this point of time. We are not prone much to kind of food and beverages shock. A particular item, if it goes up way too much earlier, whenever we were back in our childhood, whenever something would some or the other item would go up, materially, it would cause a lot of effect. So things like potato, onions, tomatoes have the natural tendency of kind of spiking up during troubled times. What this does is basically, why is this important? This is important because now oil does not have a very direct effect on your inflation. Why? Because food and beverages have while oil gets transmitted through your transport and other factors, there's a large reduction in food and beverages now, and generally you have these spike ups in food items when there is a spike up in oil. There are two things that generally lead to a particular food item getting spiked up. One is obviously oil, and the second is any shortage, any mishap during a monsoon season, a flood or something like that. So or a drought, or on the other hand. So basically that is not in our control, but what is in our control or seemingly in our control is basically oil prices. The effect or the pass-through effect that will have on inflation will be much lower. So this time around, if oil goes up, we don't expect inflation to blow up as such, like in a large number. That what that does is that in turn gives RBI a lot of room to play around the repo rate, and that gives the India story much more breadth at this point of time. This is what I think analysts are missing at this point of time. Obviously, inflation will come through, but the new basket kind of gives us much higher room to be able to transmit, or the transmission of oil basically would not show up in our headline numbers, giving RBI enough room to kind of play around with the interest rates. This is what brings us to our oil story now, and this is what we'll discuss in details, because that is on top of everybody's head. If you've so chapter 2 is basically oil doesn't ask permissions. We've shown this particular chart, I think, a number of times now, but still, if somebody is looking at it for the first time, we'll just quickly describe what this is. The idea here is that the commodity era does not announce itself; it just arrives out of the blue. However, when we looked at the last 115 years, what we did was we looked at last 115 years of basically US 10-year yields. And this US 10-year yield follows a 30-year, 35-year cycle, 35-year cycle, a cycle of downward trend, and then a cycle of an upward trend, then a cycle of a downward trend, and now possibly a cycle of an upward trend. Whenever the yields in US are on a downward trend, that means that the money is easily available, or it's more cheaper in that nature. Again, we saw that between 1990 to 2020, money was quite easily available. There was ample liquidity in the market. And in these stages, what we realized that the innovations that happen, these innovations are more led by kind of speeding up whatever innovations happened in the commodity era. So basically, the 35 years of a downward cycle or downward trajectory of US yields, we call that the technology era, and the 35 years of basically the upward yield, we call that the commodity era. Now, whenever you are in an upward yield scenario, like the yield prices are yield numbers are going up, what happens is that this money is not very easily available. So money comes at a cost. When money comes at a cost, the innovation that happens are much more deeper in nature. You want to change the world much more in a material way, because you're using money that is expensive. When that leads to a lower yield or money being very easily available, what you end up doing is that take that innovation and then build speed into it. So things like oil drilling, space race gave rise to supercomputers. And when money was more cheaply available, we took those supercomputers, made them into personal laptops, and made it a mass product. Similarly, now going forward, what we realize is that probably there will be innovations in renewable energy, water recycling, carbon footprint, some bit of biotech and nuclear tech. We've kept AI as well here. However, this is something which happens. There are overlaps between innovations as well. What we've also realized is that between the technology eras, there are a few countries that do really well, and the countries that do well in a commodity era are slightly different. Those are generally commodity rich, and the ones that are beneficiary in the technology era are basically ones that are more innovative in nature in terms of speed. So taking that clue, what we did was that we had gone long in oil, mid or oil and energy in the middle of last year, somewhere around July or August, when we were having our first session. We openly called that out in our annual report. Hardly advisors do that. They don't give you the calls that went wrong. We openly tell you where we got it right and where we got it wrong. While we got those 7 calls right, there were 3 that really put us in a difficult position. The first one was basically energy. And however, in our energy portfolio, natural gas was saving the day for us in terms of the winter in US was this time very harsh. And that is why you saw a very large uptick in natural gas prices. So while natural gas kept us profitable in that nature, we were kind of losing out in oil, which was continuously being sideways. We kept on holding, and we said that the timing looks off, and that has basically now started to play out. Now, obviously, there were reasons why we started entering into oil. The reason was very simple. We were just playing the facts that happened. And when we went ahead and looked at these commodity eras, we found that there is a pattern that actually follows. So generally what happens is that your first and foremost, your gold picks up. It breaks out from a consolidation zone. And when we entered energy, we had already realized that gold had broken out. When the next step from gold is basically that outbreak in gold leads to an outbreak in copper. So when we went long on energy, we also discussed copper at length. We've discussed a company which is given quite a lot of returns from there on. We discussed copper at length because copper had broken out from its long-term kind of narrow band of consolidation. And then just before this month, when we went much more higher weight in energy, energy has started breaking out from its longer period of consolidation. So this is a pattern that we saw followed even in the last commodity cycle, and that kind of had followed through, and that is the reason we went long in, or we went overweight, or we increased our weight in the last map session. I'm sorry, I'm hearing something. Does somebody have a question? If not, please mute yourself. Cool. So back to the session here. So that is the reason that why we went long on energy. There's a Please give me a second.
Vishal will have to mute.
I think it's possible now. Okay, cool. Um, sorry. Yeah. So just coming back to the session here. Yeah. So energy had broken out. Now again, this is something that we discussed at length. This is from our monthly outlooks. We've discussed this in our the left hand side obviously is very familiar for people who attended these sessions before. If not, I'll quickly go through this as well. There's a transition dynamics that takes place in energy. There's so basically you can be in a world in four states when there is low geopolitical tension and a high renewable adoption. So one thing that we all realize right now is that we are in the midst of an energy transmission or transition rather. So basically we are moving away from oil into something which is more renewable in nature. We've realized that there is a particular date that we are set in terms of Paris Accord, which is 2050. We have to become carbon neutral as a whole world. Whether we reach there or not is another whole story or another whole discussion that we can have. But we have set ourselves a date, which is 2050, by which we should become carbon neutral. Now, in this transition phase, generally, the transition happens in either in of these four buckets when there is a low geopolitical tension and a high renewable adoption. Obviously, we are not in this state at least. There is renewable adoption is lower, and we are not in a low geopolitical state. Why do I say renewable? I don't need to explain the geopolitical tension part. We all are facing it every single day. So geopolitical tension, anyways, is something that is describable. Why I say we are in a low adoption or renewable adoption, because the number of by now, we should have seen many EV cars on the road. We should have had at least solar panels on most of the new age buildings as well. We still don't have that, so the adoption is not as high as one should have at that to be able to reach carbon neutral by 2050. So that brings us to this particular stage, which is where there is a high geopolitical tension and the renewable adoption is low. In this, what happens is basically you have to have a price driven shift. Now, what is price driven shift is means that your incumbent energy provider at that stage, which is oil for us now, has to become so expensive that people are forced to kind of move to a new age technology. People at the end of the day, humans, we have to accept that we have very low care for our nature. If we cared for our nature much more than what we did, then we wouldn't be facing a 2050 deadline as such. So we as humans, what we care about is how much is it costing me, and we've taken this in a much deeper sense that whenever one needs to buy a petrol car or a EV car, we pull out an Excel sheet, and then we kind of fill out that this is the amount of miles that I drive, how many kilometers I drive, this is the cost, this is that, and then we come down to that Excel sheet, and then it looks like that the petrol car makes much more sense at this stage. But the big one assumption that we make in that entire Excel sheet is that we keep petrol at around 100 or 110 rupees a liter. The whole equation flips if petrol were to become 200 rupees a liter or 300 rupees a liter. The minute it starts pinching us whenever we reach the petrol pump, that no, this is expensive, I should change my car. That is when mass adoption takes place. That is how price driven shift takes place. And this is not the first time this is happening. This happened exactly in 1970s as well. At that point of time, coal was basically the major provider of energy, and oil was trying to replace coal. So what happened was basically coal became super expensive. It went from $20 a, a short ton to 51 dollars. So basically a 2.5 times increase. So imagine oil being $90 and then imagine oil being $250, right? So that's the kind of change that took place in coal, and that drove basically that's like the grave that the incumbent energy provider pushed themselves into. That is how coal got replaced by oil. Obviously, this peak came because there was an embargo on oil. So while oil prices peaked, there was a natural provider, or the coal became the source of energy for a very short period of time, and it raised a lot of prices for coal as well. So while oil became expensive, coal became super expensive. Similarly, this time around, we don't know how that will take place. War is obviously, or higher oil prices is one state, but imagine a world where in future one of these critical elements or critical metals go through their own embargo cycle. Let's say copper is in shorter supply, or there are supply chain disruptions that break copper story. While copper would rise, oil will be used very fast, and that will just spiral the prices in the future. So again, not saying that will happen. That is what happened in the past, and if cycles repeat themselves, then something similar can happen this time around as well. Now, obviously, from there on, coal has obviously reduced and gone back to your $20. This is a longer term story. Oil obviously is not going to stay at $200 or $250 or $150, whatever price you or whatever number you want to place there. It will come back to $50 or $60. But when it will come is something that we'll have to take care of. Now, all of this kind of obviously you can't plan this transition. You can price this transition, and this is how every fuel kind of gets replaced. And that leads us to one thing, that energy is going to become very expensive. And that is why, while we've discussed how gold is a precursor to inflation, there is a similar story of oil being a precursor to inflation. So that when we looked at these charts, and this is oil prices, a 3-month average oil price and a 3-month inflation price average. When we look at the entire cycle, you can see that oil prices react first, and then inflation comes through. So basically the pass-through effect from oil. So oil, whenever it goes up, your inflation follows next. Whenever oil kind of comes down, your inflation comes down. So basically, you can look at this entire chart, and then you can look at the what we realize, that the correlation between when we did the correlation between the two of them, what came through was basically when you lag your oil prices by 3 months, or basically if you were to compare between inflation and oil, there's a 2 to 3 month transmission period that takes place. So when oil becomes higher, it takes around 2 to 3 months for inflation to kind of pick up from there on. So one thing is for sure, that we are moving into a very inflationary world, a very expensive world. And in this expensive world, we come back to that CPI basket. Maybe it may not show up much on your headline numbers because your food and beverages have gone down drastically, and oil prices don't get transmitted through there. So maybe the headline numbers may not reflect much over there. It will give RBI a much more smoother way to kind of manage repo rates, but be prepared for a kind of a expensive world coming forward. Things will be much more expensive than going forward. We also looked at gold versus oil and tried to figure out if there are any stresses in the system. The general median of this particular gold oil ratio is basically gold is supposed to be 20 times as expensive as oil. So basically at this stage, when if oil is 90, then gold should ideally be around $3,800. Now, obviously, gold is not at $3,800; it's somewhere close to $5,000. So obviously, you've got, and we did this at the end of February. So obviously, this ratio looks slightly higher because the war started on the first of March. But the ideal scenario is that the long-term median average is that gold has to be 20 times more expensive than, or gold is kind of, doesn't need to be, but gold is generally 20 times as expensive as oil. Now, there are a number of times that this particular ratio has gone above the median. There's this entire period between the late 80s, and then there is this massive period during the COVID crisis. What we realized that these two particular areas were when your demand had kind of collapsed. You were facing a recessionary environment here in the US, and you had the Asian crisis here. So basically, this is the period where demand for oil had collapsed, and obviously during the COVID times, everyone was home and large number of things were in shutdown. You had absolutely no demand for oil, and oil for a brief period went below zero as well. So in that stage, the gold oil ratio has kind of spiked up. Now at this stage, there is no demand crisis as such. People are still consuming oil. Things are going as usual, but there is a flight to safety as such in terms of people are moving towards a more safe haven kind of there's a loss of trust in terms of institutions across the world, and that is why you have central banks buying up gold and silver as precious metals. Now, this is for the first time that we are kind of seeing a very different scenario in which this particular gold oil ratio is kind of going up. It's not going up because demand for oil has kind of collapsed. It has going up because demand for gold has gone up. Hardly happens ever. So this is for the first time. What we realized here was that there will be, at least gold will be able to pull oil upwards, because this at some stage there is a valuation gap that comes in, and that is what we saw in those three charts. Basically, once gold breaks out, it moves to copper and then it moves to energy. So that is the reason that we placed ourselves higher in energy last month as well. What we realize also is that whether this particular ratio, is it going back to 20? I don't think so. Honestly, it would drop, let's say, to a more or more average level of around 35 to 45. But going back to 20 would ideally mean that oil is at $200 and gold is at $4,000. In my head, I can't place a scenario where both of these could happen simultaneously. If it does, then we will go back to 20x. But at this stage, at least in my head, I can't think of a scenario where oil would go to $200 and gold would then come down to $4,000. That looks kind of least likely to happen. So that's there. Also, one more thing, that when we looked at oil and equities, we saw that there are two distinct relationships that take place. So there was a relationship that got broken in 2008 at the Great Financial Crisis. Prior to 2008, equities was leading oil. So basically, equities would go up, there would be demand in the market, and then oil would follow through. So basically, you had these spikes in equities prior to any drop in equities would pull oil down. Any uptick in equities would pull oil up. The columns behind is equities, and the green line here is the oil chart. Post 2008, the relationship has flipped. Basically, oil drives equities now. This is more in terms of more in terms of a demand kind of a thing, wherein that relationship has become very different. So now when oil goes up, your equity market follows. And if oil collapses, then your equities market start tapering down. Again, we've seen that oil prices again have started kind of giving a higher return of late, which we think the relationship could continue going forward, and that would drive equity prices as well. Our honest read on the war, till now we've been very bullish on oil across, but obviously, if we are to bring you institutional grade research, we can't just have one bias, which is bullish on oil. There is obviously a bear case as well. So we've noted down these 4 points wherein which can take place and how we will react to it. Basically, first and foremost, on the left hand side, if you look at the inventories across the world in terms of oil, they are starting to rise. So basically, they have had their own breakout in a way. So so countries across the world now will start keeping a higher inventory of oil, given that there is more volatility in terms of the areas that produce oil. So that is one way of kind of reducing the risk of kind of any volatility in oil. So inventories are rising globally. The shock absorption is higher than how when Russia Ukraine happened, or the first kind of Israel Gaza kind of conflict started. So that is the bear case for oil, and this is why there is a rising inventory which is reflecting fear. But we realize that this inventory, even if it goes up, these inventories will be managed at a higher level, rather than any country going and depleting their whole reserves. So basically, this provides a floor rather than brings down a bear case as such, brings down the prices of oil. So what we've got now is basically a floor. So that is why we continue to hold on to our energy positions. There can be a ceasefire or de-escalation across the geopolitical premium that oil has right now. There can be a ceasefire and a de-escalation. Obviously, that removes any spike risk that can happen, something similar to what happened yesterday and day before, where oil has moved from $70 to $90 in a very, very quick time. Those kind of spikes may not come through, but eventually, again, we have to realize that that strait is not going to get wider. It's going to continue being that narrow bridge, which kind of pumps out 20 million barrels or whatever, some percentages or very large percentage of oil passes through that particular strait. There's a bear case that inflation's second wave, which we fully believe is coming, because we raised that as a risk in our annual outlook as well. We believe that the second wave of inflation is going to come through, and oil will be the driver to that particular thing. But the new CPI, we've just discussed that the new CPI basket dampens the transmission thing that will come through. So RBI has more room to kind of go ahead and play with those repo rates. And OPEC spare capacity could flood the market. Well, the spare capacity for OPEC has actually, when we realize, has been lowest since 2008. So the gap is not as open as a number of your, open fin influencer kind of channels are showing you. So with all of that, we continue to remain at least bullish on oil. And just on the previous slide, we said that oil kind of transmits this particular uptick into equities as well. So basically, what we are kind of at this point of time, what we are seeing is basically a risk that is known. So if a risk is known, then the question is, does it remain a risk anymore? It does not. So that is why you see countries kind of being able to manage their particular inventories as well. So this gives a floor price to oil, and spikes also kind of will get removed. But we are moving to an expensive world with a higher oil price, and that gets transmitted into equities. How do you, if what we've done is we positioned ourselves with facts. So basically, the fact for going long on energy was the fact that gold had already moved up. So similarly, if kind of oil has moved up, where do you place yourself? So a number of people, whenever they see oil going up, they end up buying companies which are OMCs, basically the marketing companies. They end up going and buying BPCL, HPCL, and others. That is not where kind of we see generally, that is not where the rise in prices gets translated into. The rise in price gets translated into drillers. So when we kind of took four different periods where oil prices had gone up, and we did a correlation between OMCs and drillers, we found out that OMCs have a correlation of 0.12, while drillers have a correlation of 0.32. So if with the fact that knowing that oil prices are going up, where should you place yourself? So we're placing ourselves into the companies that are drilling oil rather than the ones that are marketing companies. With that, I think we'll move on to how we are positioning ourselves. Obviously, we are positioning ourselves. There's no change in our position since last time around. Even though the markets have remained choppy, our sector allocation has taken the whole weight of delivering positive returns. So given that we have been kind of overweight in metals, in infra, in energy, those are the ones that are kind of driving positive returns for us. So India still remains the standout place that we want to be in. Given that there is a cycle dispersion, India is in the mid cycle, US is in the late cycle, and this basically creates a very arbitrage opportunity for us to be in a country that is kind of growing fast and has a higher, forward leading indicators as such are also pretty much high. So that gives us a stage where we want to be overweight on India. We've not even changed our even with the dip in US, we are not changing our stance in US. We continue to remain underweight in kind of US. We've started to look at Europe, especially UK, that is turning around the corner. We want to continue to watch it for a month or so more before taking a stance on changing our direction there. And in terms of China, we continue to hold despite projections for GDP coming lower. We'll again watch it for a month or so. The projections have just come out last week as well. We don't want to react to it at this stage, but we continue to watch it. If there is a certain need, we might just reduce China back to neutral. With that, we get a lot of questions now in terms of whether one should invest into US right now, and we get it, right? You've got your advisors, the number of people advising you. You're looking at your past returns, and past returns for US over at least the last 2.5 years, 3 years. India has gone nowhere while the US has continued to chug along. And that is why your advisors or a number of fin influencers as well tell you to place yourself in US. The kind of words that they end up using is basically rupee is devaluing and you will get diversification benefit, and hence you should be placed at US. We've got a slightly different view in this. So what we've done is, again, we've gone ahead and taken our ratio chart. What ratio charts do for us is basically they tell us where you should place yourself and whether things are overvalued or undervalued. So what we've done is we've taken the Vanguard X US ETF. So this is all the entire global, the rest of the world except for US, and we've taken the ratio with S&P 500, which is US. Now across time since the last 15 years, this was on a downward trajectory. So basically your rest of the world was underperforming the US markets, and this was on a downward trajectory. This particular trend line, which has been held for quite a long time, has kind of been broken out mid last year, and now it continues to stay above this. There's only one small time that it went above this. This was during the COVID crisis. Apart from that, it's never stayed above the trend line for a long period of time. So what this tells us is to position ourselves in the rest of the world ahead of US, and that is why you see our positioning here, that we continue to stay overweight on different nations rather than go into US. In terms of sector views, we continue to maintain the weights that we did last time around as well. Continue to remain overweight old economy stocks. Things like infrastructure, energy, metals make a lot more sense to us right now. We've not gone ahead and changed our IT view as well. I know a number of people want to get into IT, given that it's fallen off a lot. We were still looking at it. We tried to maybe just find out good places to figure out in IT. For us, the rest of the sectors are making much more sense at this point of time. We again will wait for another month or so to find out a good IT stock to be able to place ourselves. Given the disruption of the H-1B visa and the AI and the cloud co-works, and one after the other, you keep getting all these different news in IT. We've not found a good place to kind of figure out in terms of IT. So we continue to be underweight there. For us, the rest of the portfolio or rest of the sectors kind of make much more sense to us, and hence we are placing ourselves there. This is where we kind of, again, this is from our outlook map, which this was placed in the macro outlook one, which came out last week itself, where we are kind of the reasons why we are overweight on industrial, financial staples, materials, autos, and energy. The reason why we are doing that is basically that Indian IIP is kind of improving. Credit is kind of going up. Your PMI numbers are pretty higher. It's cooled off from 60 to 58.9 or something, but it's still at a higher number. and all of these are beneficiaries of that. The latest one that has joined in is obviously your energy, for reasons much known to everyone. Here, at least in our energy, our top picks remain the drilling companies rather than being in OMCs. Very quickly on earnings, again, people are not kind of convinced on the India story. Obviously, the last quarter has been a slightly more difficult. However, with that, when we actually look at it, there are 33% of the companies that have given higher year-on-year sales when compared to the same quarter last year, higher year-on-year profits when compared to last quarter, same quarter. When compared to last quarter itself, sales have grown higher, and last quarter's profit has grown higher. So there are 33% of the companies that have done that. Along with that, we've applied our own quality matrices to these kind of companies. Look at a number of other sector plays as well, and we still find enough and more kind of companies to add into our portfolio. The ones that have given good results, we've been placed in all of them since before the numbers came across, and this is basically how we've developed the framework. Our framework kind of are able to pick up what we've realized is our frameworks are able to pick up sectors ahead of numbers telling us the story. So that is how we've built our whole framework and the system. These are the sectors with the best results. We've been in public banks since again a long period of time. We moved to electric cables. We were in metals. The sectors that kind of did not do well were basically gas and agrochem. These are the sectors that probably look a little more exciting now than what the returns at least showed for the last quarter. In terms of debt, we don't want to be in debt. Honestly, in an inflationary world, in a reflationary inflationary world, debt makes no sense in the portfolio for us. So we continue to be very light on debt. We don't want to kind of go absolutely underweight as well, given that there is some bit of room for maybe a cut, very least likely now, given that oil is going up. I mean, FOMC also meets mid of March. Again, when RBI also meets, it looks very difficult that a rate cut could come across. It just does not make sense for us. We've also deployed all of our cash as well, because the dip also made a lot of sense, given that inflation's or oil spiking up, inflation is going to come, and oil can transmit that uptake into equities. It makes sense for us to be deployed into equities. This is how our asset allocation looks like. Equity, debt, gold, and silver, and cash. Obviously, we've got no cash right now anyway. We've deployed all of that. Debt remains very low across portfolios. We're not interested in debt at this point of time. Gold and silver, we're holding again for this particular small time period where it kind of remains, in a sideways direction. For us, at least, equity will be a direct beneficiary of oil transmitting positive returns to that. So that's how we've kind of positioned ourselves. Inside equities, obviously, what we've done is for a conservative, moderate and aggressive clients, we've positioned differently for in large cap, small cap, and mid cap. That is how we kind of building kind of risk labels into it. However, in terms of asset allocations, the cycle just is one where it does not matter which risk label you are in. It is the environment, the cycle that we are. I cannot be more bullish on equities at this point of time. And that leads us to where Nifty is at this point of time. It's just right at the top of a strong demand zone. We've continued to show you these charts again. The supply zone is very far off. It's around 1,200 points above, and demand zone between 24,350 and 23,800 looks like something that would not get breached. So in terms of that, we just right on top of it. Any other further, like let's say in a week or two, if you find yourself again within this demand zone, those are opportunities to buy through. We would continue to play through the choppy market, how we've done across the last 1 year. Again, buy at demand zones, sell at supply zones. However, we think that if the market has to take out this supply zone, it has to do something like what oil had done. Just take it out within 2-3 days. In a way. Similarly, if the demand zone were to be taken out, then it has to do it in either a gap down or a 1-2 day period. We think a lot of negative news has poured into the market, be it from geopolitical side, be it from every other section. We don't see any other risk that can develop that can actually bring the markets down below a demand zone. Um, we we we've, we've tested this here back in back during after Operation Sindoor. We did not have a trade deal. That is when we kind of went ahead and tested this demand zone. Similarly, again during this geopolitical crisis is when we are kind of testing the demand zone. So this demand zone is particularly a very strong one, and we're right on top of it. There is no reason for us to not believe into it and buy it and hold on to it. In terms of returns, obviously we started. We're 35 months into the period. We've seen every market condition. We've seen market conditions where it was just buy and hold, to market conditions which are choppy. The framework, the system kind of continues to give positive returns for us, and that is why we continue to believe in the framework and the system. Uh, with that, I would just say that the volatility is noise. Allocation is your choice, so choose wisely. That's it. I think I'm open for questions. We've been pretty much on time, so if there are any questions that anyone has got, happy to take it on. Cool. I think this was a session which I happy to take any question that are there, but given there is a lot of fear in the market in terms of people not believing in the equity story at this point of time, I think those fear and greed is like a pendulum. Extreme kind of fears are the reasons why fund managers and advisors exist. This is the time that we are available in terms of, if you're not believing in the story, do reach out to us. We continuously bring out a number of. Vishal, go ahead. You raise your hand. Is it okay? What do I think about the dollar? That's the question from Vishal, as to what do I think about the dollar. Right. So we kind of bought this out last time around as well. If you actually look at it, dollar was playing kind of the very similar to how it was doing in Trump's first term. It's slightly doing a little different in this particular month. It's starting to find some bit of its ground in terms of, because of it being a safe haven kind of a thing. However, given that US is losing popularity, and the dollar debasement, or in terms of losing its kind of reserve currency status, is something that we kind of think. Again, it cannot happen tomorrow, or it cannot happen in a week from now, but may happen, like, let's say a few months or a few years down the line. That continues the story. We believe that continuously dollar would kind of lose its value, given that the large debt that US has gotten itself into, and it's fighting wars that it cannot afford. It's just getting into a trap that it cannot get out of from. So I'm not very sure about dollar, at least from a year or 2 year perspective. From a short term perspective, let's say from a month or so, maybe dollar may find some bit of footing, but that demand or that strength, at least in dollar, is particularly not. Uh, yeah, I think I've people can unmute themselves now. I think that was played out. So I think if that's, yeah, I think, yeah, that was the problem. Okay, sorry, didn't realize. Sure. Okay.
I have a question. Do you have any opinion on the defense sector as such? I mean, because
Sure.
they are becoming quite popular nowadays, but again, not a good return in last 1 year or so.
Sure.
So,
Sure, Shubham. So, thank you for the question. In terms of industrials, if you actually go ahead and look at it, what we've done is that we've realized that within industrials, the ones that have had capex already done, right? In terms of the defense sector itself, the capex is already done. Now that gets the order book is already there. Now you have to and the capex is done. Now you have to execute the order book. So now it starts trickling down into your bottom line effectively, and we're very positive on defense. Defense is already there in all of your portfolio, so you guys know how positive we are on defense. In terms of it's not giving us return, let's say over the last 6 odd months, I think we given taking some bit of kind of energy from oil. We always around 6 months early into the cycle. Hopefully, it starts doing well going forward. There are a few names that have done well for us. I think Bharat Electronics continues to give us returns. Very recently, I think Garden Niche has also started out. Similarly, Bharat Dynamics as well kind of would start playing out. For us, at least when we started looking at the industrial theme, we started looking at defense first because at the end of the day, having an order book and not executing it works the least in defense. When you get attacked, having an order book of a fighter jet is not going to save you. Having a fighter jet on the ground is going to save you. And on that very same breath, having an order book of a steel bridge, if you don't go ahead and execute that, that has a much lower implication in terms of national security. So at this stage, we are quite bullish on defense and going forward as well. I think that's the particular sector to look out for.
Got it. Thank you.
Thank you. Vishal, Rahul, hi.
Yeah, Karan. So, Karan, you said you have put in all in no cash and anything. So, in
Sure.
this period, I think we should be getting opportunity to buy in some bottom fishing can be done. So, what's your thought around that?
Sure. So basically, we are obviously doing a number of bottom fishing type. We're not bottom fishing in sectors that are not liked by the industry. We're not bottom fishing at least in ITs, but we are kind of finding opportunities in terms of industrial drillers, power transmitters, um, ports, materials, things that have. So what? How do we react? Is basically we take the fact that is there. So what is the fact right now is that we already know gold and silver and copper have started their move up. There is a massive shortage of metals across the world, right? If there is a massive shortage of metals across the world, we then what we do is we go into how metals are produced. And similarly, when a particular name that we really like in terms of production of metals through the electrolysis process is basically graphite rods. So we've kind of very positive on graphite story and the carbon black story. So we continue to find opportunities like that. The whole framework is like that. We take what is the fact and then try to find opportunities rather than second guessing ourselves in terms of whether this would do well or not. So yeah, there are opportunities as such. We finding decent opportunities every day.
Yeah, no, so just a thought process like we should be sitting on cash to some extent at this point of time because in the world of turmoil, we might be getting some opportunities in next couple of months or like stay invested or stay put. That is
Sure.
all.
Sure, Rahul. So this is a true story here, and honestly, I'll tell you. Similarly, I was having a discussion with a client, and back in when tariffs were announced, and the world was similarly kind of volatile. So the question at that stage, I think Nifty was around 21,500. I called almost all of you up in terms of asking that this is the right time to kind of go ahead and invest. Despite volatility, the client told us that Karan, I don't think I can see green shoots right now. I'll wait. I did tell him that when you actually find green shoots, you'll find the market to be at 25,000 and probably everything priced in. That is what happened eventually, that they did find green shoots at 25,000, 26,000 when we were not ready to deploy cash. So basically, volatility is kind of the place where kind of we find opportunities. If you wait for obviously waiting and finding a time which is less volatile is more comforting. It is more in the comfort zone. While you do that, first and foremost, I don't believe the world is gonna become more kind of less volatile or something. We are in a world which is volatile, uncertain, complex, and ambiguous, and we continue to be here. This is a changing world order in real time. So in terms of less volatility or better opportunities or stuff like that, I think that waiting for those is something that you'll wait for probably ever. What I've realized is that in an inflationary world, Equity is one that protects you in terms of capital. While there are other stores of value, you have to buy them before inflation kicks in. So if you're looking at an inflationary world and inflation hasn't come through yet, buying gold would make sense. But once inflation has hit, gold is not going to save you. That is equity that is going to save you. That gives you outside returns while debt kind of eats away capital or buying purchasing power. So yeah, a long winded answer short in terms of if we keep waiting for better opportunities. First and foremost, I don't think those are coming. And secondly, volatility is the place that we kind of find out reasons to be invested into right now. A lot of number of things are in our favor in terms of right being above above a very strong demand zone. It would require a massive news to break this kind of demand zone. Something that we don't want to kind of say it out loud, but that if such kind of an event takes place, then only this demand zone gets taken out. We honestly don't think that should happen.
Okay, thanks.
Thank you. Vishal, you had a question. Okay, lost Vishal. Sorry. Any other question that we can answer to?
Hi.
Sorry, please go ahead. Yeah.
Hello.
Hi.
Hi, Karan bhai. Sonal here. Karan bhai, I just wanted to ask this one question because you have definitely studied a lot of history, and I'm sure this is not the first time the crude oil is rising above its median level. In the past also it has gone up a lot, and as you rightly said, the inflation also will follow the rise in crude oil.
Sure.
After the inflation follows, I'm sure the government and the RBI will kick in to raise the rates, repo rates, and all that. So, do you think that after that, increasing, tightening the repo rates and everything, the markets could follow down and volatility would be reduced, or what has happened in the past? If you can explain that.
I got the question. Thank you, Samuel, for the question. Sure. So again, while the question sounds that it can happen over a 5-day period, it does not. So while oil going up, inflation coming on after 2-3 months, RBI reacting to it in another 1-2 months, whether they can react, cannot react, they'll also have to follow the Fed. And remember that the Fed has a lot of dollars to kind of they have a lot of dollars. Basically, they have to refinance themselves. They are at $8 trillion debt. So, yeah, all of that will take place. Maybe RBI may come in and say that inflation's gone out of control. Let's raise our rates. That gets trickled into the economy another 6 months later. So we've got time. In the past, obviously, whenever oil has gone up and inflation has kicked in, markets do follow a downward trajectory after a period of time. So what do you do? How do you protect yourself while the world is inflationary? That is where equities come in. Obviously, equities will become overvalued or become expensive after some time, and that is the time that we'll reduce our equity positions. What we've also done is basically, if you very quickly, what I'll bring out here is that our annual outlook, and this is a particular scenario that a risk that kind of we got into. Sorry. Stop sharing. I want to share my screen. Yes. So this is our annual outlook. I think you all have seen this before. And in terms of risk that we were kind of watching, yeah. So these are the risks that we kind of were watching at the beginning of the year. The annual outlook came out on 1st of January. There was a particular outlier risk of energy that we kind of flagged up. There was this inflation second wave, where at that point of time, while the probability looked very low, the impact was very high. And that in that case, our CPI for at least for 2 months, if it goes above 5% and oil remains above $100, And if food inflation returns, this is about before the new basket was released. So basically, all of these would mean that we'll bring down our equity positions, which are right now around 80s to 90s. We'll bring it down to 60%. We'll increase our gold positions, and we'll just look at quality companies rather than chasing kind of other random normal usual retail names. So this is how we'll hedge ourselves if this happens. So these are our early warning signals for different kind of risk across the world, and this is our reaction to it. So again, as I said, that there's an entire framework and system looking at a number of things, and we'll continue to position ourselves as and when data comes through.
Got it. Thank you.
Hi,
And
Karan. Nipul this side.
Please. Go ahead.
So I think, first of all, want to comment. I think really good insights, well put together. Thanks for that. So my question is, around the tariff ruling that came in, right? I don't think we touched on that. In case we did, I missed it. So what's your reading of that, right? So going forward, like after all this geopolitical sort of settles down, how is that going to play out? Like any views on that? So we were 18%, then the ruling came in. So what's the view on that?
Sure. So obviously, a number of things get the war and the geopolitical tension has subsided. A number of discussion points that we want to discuss, and you're correct on terms of that we've not discussed the tariff rollback. Honestly, we didn't. We thought the session would, if we start looking at everything, the session could eat up our evening as well. So we were conscious of the fact. You're right to bring it on right now. What has happened is basically the section has changed. The tariff numbers have gone down. Trump has so basically earlier, let's say Trump had an entire canon with him in terms of, let's say, in terms of the section that he was using was fairly illegal to begin with, but whatever he was using, he could go ahead and bring out any number that they wanted in terms of. Now that canon we think has been replaced by kind of a water gun, which kind of runs out in 6 months. So the section that being used right now has an expiry of 6 months. Also, it has a maximum limit of 15%, beyond which you can't do anything. So, and in 6 months' time, US heads for midterm elections. There are a number of other things as well that will affect the midterm election result. Things like a few files across the world, which possibly, I don't know, if you look at influencers across the world, you will see conspiracy theories as to files being buried in places which are being attacked and whatnot. We do not know about that. So again, as we head to the midterm elections, one thing that we know, the fact that we know that 15% is the tariff limit. 6 months is what they have now, and across the world, you just put tariffs just because. I don't know, because he wanted to attack Iran, or the tariff, or Supreme Court, their own Supreme Court kind of struck down their own, precedent kind of tariff laws. He wants to put 15% across the world. How good is it? How bad is it? It will get contested in the Supreme Court again, whether this particular section is legal or not. That will take some bit of time. Till then, again, disruptions across the world in terms of tariffs will continue. How do you? I think tariff has become now a backstory. Everything's, I think, gotten priced in over time. I don't think people are looking at now, tariff as a bigger thing. At least the market is not looking in terms of it being a more bigger driver as such. So I think yeah, that's full and short, and that is why I think we did not discuss it, because honestly there is nothing to discuss. This is 15%, 6 months time period. In 6 months time period, we head to the midterm elections. Trump's popularity between US citizens is at an all-time low. It's lower than any precedent ever. So yeah, let's see what happens when October midterms come through. That's about it.
Got it. Makes sense. So as of now, it's like a non-event, if I can put it that way.
Absolutely. I mean, nothing to place yourself with. What do you do? Like you were at 25%, you were at 50% sometime. Now you're back to 15%. Yes, it's good for India. It's good for, but now we are as competitive as, let's say, something like a Vietnam or something like that. Everyone on most at same level footing. So yeah, obviously it's worse than what we were before. We were at 3% or 5%, whatever number that is. We went to 50% and now we are at 15%. So yes, we are worse than before. Could this be better for US? Yes, it could be better for US. I don't know how, but it could be. For that, what we've done is that we're looking at companies which, at least in the US, which are which are good in terms of valuations, which are good in terms of sectors that are in kind of favor, not the ones that are running away beyond what their valuation should be. So again, looking at smaller names in US in power, in energy, in drillers, in so similar things, but at least in US small cap, that is where valuation is making sense to us. Valuation for big tech names is not making sense to us.
Got it. Fair enough. Thanks for that.
No worries. Thank you so much for the question. We've got another question here on the chat, which is that what is the Indian IT outlook? Basically, in terms of Indian IT outlook, sir, we are not placed there. Honestly, it looks. Yeah, it looks like it's bottoming out. The valuations are in favor. I think all the bad news that could have happened, H1B maybe, but you know, the issue is not with IT. I think, or the cloud cowork AI things is not with IT. It is more with to do with sectors that it goes ahead and replaces. So maybe the problem with Indian IT is we are a very services-led kind of IT market. We're not the ones that are kind of creating massive or very great AIs. We are the ones who service it. And at this point of time, AI is trying to replace those kind of services that we provide. So that at least in terms of, even if we talk about jobs, the early coders or the ones that are early in their career, those are the ones who are facing trouble, because your Claude or your Chat GPT could code your first bit for you. However, what we realize is that the roles may change, at least in terms of IT. Something in terms of there's nothing called a AI guardrail at this point of time. There is nobody who's checking AI outputs as such. So those kind of outputs or those kind of services is what Indian IT companies can bring out, and that is why we continue to look at this particular sector. We've not found a decent name to look like to put it in our portfolios. We tried out a company, it didn't work out. We're still looking at them, but honestly, at this stage, the rest of the sectors are doing their job for us. We're not chasing IT at this point of time, although valuations do look attractive. We've not found a decent name to add. That's the thing. Okay, another question is basically, do we have any views on the Korean market or AI hardware market? We continue to remain, at least in terms of Korean markets. Yeah, they are they are doing well, honestly, and the recent downfall that you see, at least in the Korean market after the uptick, is some bit of volatility kicking in, some bit of profit booking. We continue to remain bullish, at least in terms of AI hardware. We've found companies that clean semiconductor chips. We found companies that bring out foundries. Again, different players available. We've also found recently a company that cools AI system. So yeah, different players available. Very decent players. Korea, we continue to be liking in terms of, but valuations look very difficult to be going forward with. So if I were to place money today between Korea and India, I think I have good names, at least in terms of valuation comfort, in terms of number of names in India. Not particularly AI, but in terms of other industries. Just for example, shipbuilders in Korea have valuation, I think, 4 times that of shipbuilders in India. Why would that be? I mean, if shipbuilding can be very similar to each other, why does Korea take a premium there? And if that premium is warranted, why doesn't an Indian shipbuilder get that same premium? So I would rather place my money, at least in terms of that Indian shipbuilder. Similarly, a oil driller, a major PSU oil driller, ONGC, has EV EBITDA of around 4x. Global average is around 7x. Why would that be? We've just as an economy we've done well. As markets, we've not done well over the last 15 months, and that is where there are a number of opportunities in terms of valuation that look very attractive. And the sectors that are producing well, we putting our money there. We're not looking at Korea as such. Honestly, SK Jeans and Samsung, etc. We continue to like, but valuation wise, we find more comfort at least in other sectors here in India. So I don't know. There's nothing bigger to look at. Is it better to focus on global IT services company or Indian IT services company, especially considering the significant changes Indian IT sector may face due to AI? How if I were to play the AI theme again, I would play it through the hardware and different opportunities available across the world. At this stage, the only thing working for Indian IT sector is the valuation. They've never been so attractive. That is the only good play. How does the role change? How does it affect it? It's too early to call. Honestly, I don't think those kind of jobs have it is not become mainstream. So I would rather play AI hardware supporters, which are valuation wise very comforting. There are certain plays available across the world, mostly in China and in terms of in US as well. There are a few plays which are available. So we'll play that rather than, yeah, the only positive thing about Indian IT sector right now is the valuation. It's never been so, or in the recent past, it's never been so attractive. That's the only thing. I think that may warrant us to look at Indian IT, and that is why we continue to like give us a month or so, and we'll find out a good name inside that, possibly place you there. But that's the only thing that works for Indian IT for us. What is your opinion? What is your opinion on the global aerospace industry turning to India as a supplier builder and existing automotive OEMs getting involved in this segment? Global aerospace industry turning to India as a supplier builder and existing automotive OEMs getting involved in this segment. We too early in that cycle. We at this stage, at least in terms of OEMs, while we can produce those kind of OEMs which are required, let's say in warfare, the major we still lacking some bit of capability to build major decent ones. In short, in India itself, the order book for defense and aerospace is so large. If they fulfill that, those names will go places. They wouldn't require an outside force to make them give you returns. If they do, that would be another whole story to look at. At this stage, we're not honestly looking like, or we're not hearing or looking at those kind of deals coming through. If you know of a particular thing, do reach out to us and we'll look into it, and we'll look at that OEM as well. But at this stage, at least on the surface, we've not found something. For us, the defense sector is very clear in terms of order book is so much, and in terms of they've not executed those order books as well. At least they go ahead and execute that order book. That will trickle the or that will raise the bottom line so much that effectively we'll be at a very good place. So we're not looking at least I've got at this stage I've got not much opinion on what could happen. But if there is a particular company that you are aware about, do reach out to us, and then we'll figure that out going forward. What about the refineries in India? Considering India being a major exporter of oil, refined oil, every country would also like to stock up oil in the near future, considering current geopolitical scenario. Sure, and as refined oil, more than that, that's a very good positive for refineries in India, and we continue to build that. What we also like is basically drillers and explorers in the oil space. I'm sure we've got decent number of places, we at least in the basin of Andaman Sea, where a number of things can take place. So we're looking at drillers, we're looking at refiners. It continues to look really good for us at this stage. However, I'll be very candid here in terms of that this oil spike which we've seen between $70 to $90. just one statement out there may drop it back, and we've seen this, right? So one statement out there can drop it back to 78. At this stage, oil refinery and oil drillers is such a easy theme that everybody would get in and the bus would become heavy. That's what the conversation that we have. I'll just tell you that, the bus will become very heavy in terms of very fast. And that is never a good thing. That the bus can't run when it is very, very heavy, right? So for that, the bus has to get lighter. And in that case, maybe you may see some bit of volatility going forward, so that is why we build a portfolio. We just don't give out one to stocks as such. This looks good, this doesn't look good, because we can't place 100% of our portfolio there. So that's a very big risk of a number of people getting on board onto this oil refinery and drilling story very fast, and that will lead us nowhere because the valuations will just spike up. And then it will expose us to the risk that if oil prices were to fall, let's say some similar to silver, right? Silver went from being 100K to 400K, right? So 1 lakh to 4 lakh, and then it dropped to 2.5 lakhs. Similarly, let's say if oil were to go from $70 to, let's say, even $110 and were to drop back to 80, that would create a lot of chaos inside the market. So again, while we are overweight, while we continuously look, be very sure about the quality and the valuation that you are getting into, because just having two names in your portfolio and just building a portfolio out of oil drillers and refiners, however good it looks, it exposes you to risk of just one statement saying that there is a ceasefire and oil drops back 15%. Obviously, the bus at that point of time will get very lighter again, and that would bring out a brilliant opportunity as such. So and that would make more sense. But it's a sector that everyone's looking at. We've been placed early into the sector, and in terms of that gives us a lot of valuation room to play with. That's the only good silver lining out of it. If it becomes too heavy, valuations become very atrociously bad. We probably look at it from a very different angle in terms of reducing the weightage in the portfolio, and then once it becomes much more cleaner, maybe get back in again. Let's say so yeah. Cool. Thank you so much for your questions. Again, I've always said this, and this is the power of, I think, having webinars in terms of in the world of AI. I think knowledge becomes secondary. I think curiosity is where a number of things will lead to, and these webinars, as useful as it is, I hope it is useful to you guys, but it is extremely useful for us in terms of the way, the curiosity that it builds for us as well. We'll go back, we'll take care of these questions, we'll discuss a number of things among the team, and it just helps us in our analysis as well. In a world of AI where a number of data points can be researched within a few minutes, it is conversations like these that are very meaningful for us. So very happy to answer questions after the webinar as well. Do reach out in terms of if you've got a question, because curiosity is the edge, I think, in the world going forward. The world will continue to remain volatile. I don't see any other reason not to be volatile. We have another number of events coming up in terms of the world geopolitics. The midterm elections will be a large one. What happens between now and midterm elections and files across the world, something other comes up. There are issues in Cuba now. If you would see, there are issues across the world. I don't know how many wars US can actually fund itself. It's just getting into a bad trap going ahead. They're not gonna. It's just something. It's a very simple fix. Go ahead, reduce your spends, not go ahead and increase your spends. The faster they accept it, the easier it would be for their economy. If they continue to fight wars they can't afford, they're not going to go anywhere. It's going to lead to a kind of a difficult scenario, at least at the end of this year or maybe beginning of next year. So having said that, do reach out to us. Happy to host you, and have a good weekend ahead. Thank you, guys.